Okay, hi there guys. Just let me know if you can hear me. We'll see who we got on today. Sharon, Jane, Pete, how are you going? All right, I think I'm coming through. Just can now. All right. So, Merry Christmas, Nelly. I'm not sure about next week doing a stream, just a couple of days before Chrissy. So, look, just keep an eye out for it. More than likely, will be with the trade setup anyway. Is just having a bit of a break for a week or two. Which just means no streams. The alerts will be just confined to management alerts or potentially if there's a new trade popping up, but not any of the morning jump starts or anything like that. So it gives time to everyone have a bit of a break, consolidate everything, and see what happens this Christmas. Last Christmas we took off from basically I think it was Boxing Day onwards or Christmas Day onwards. They had to lower the day just before that, and then up she goes. So we'll see what happens this Christmas. Whether we have a strong, finish to the year and a strong start to next year, that would be interesting to see. I think there's a lot of people thinking that coming up to the US elections in 2020. So that's sort of the next big thing. I think the trade war has taken a backseat, at least with a phase one deal done. I don't think it's 100% from what the US says. Yeah, we're legends. It's done. Da da da. But it seems that China haven't quite confirmed, and there could be a few little sticking points. But I'd say that the bulk of the deal and what's involved in it is done. They might. I mean, they're always going to have a few little sticking points, but I think it's a big step forward. With regards to trade. So I think the phase two, they haven't set a date. The talks are going to start probably into the new year, commence in the new year. So you could potentially expect a bit of a rinse and repeat of the same action that we've seen recently. So it'll be interesting to see how the US, now that phase one's done, what that means, if it's all been factored in. I mean, because the manufacturing numbers should start to lift, find some support in the US, which means better growth, higher inflation, all that sort of stuff down the track anyway. So it'll be interesting to see how they play out, whether the market's actually factored a lot of that in into new year, into early 2020, or we've got a lot more upside in this market. Strange day today in saying all that. I thought, we're going to open up about 30 points up after last night's action on the SPY. Yet we opened up about 15, I think. So it was weird, and we're probably down about break, maybe up a few points now. So it was a bit of a locking in from yesterday, just below the all-time highs. So I'd love to see it consolidate below here and then bang straight through it. If that's the case, then that could be quite bullish. If not, we start to fail off here and we keep try to test high, and selling keeps coming in. There could be a bit of a pullback on the card. So we'll go through that in a minute. Anyone that's new, welcome. Welcome to Trade Setup. I was meant to go through the introduction before I started yabbering on, but yeah, welcome. You can see on the screen, you got top left-hand corner is Twitter. Follow us on Twitter. Top right is your Facebook. Best just to follow straight on Twitter. They're all the same anyway. And the bottom right is just YouTube. Subscribe to us at YouTube. So it's at Trade Setup, capital AU. So I'll get rid of that. Let me just delete that. Now, what I want to talk about today, we'll just go over the markets a bit. Take a look at, obviously with the Dow up there, the daily on the Dow, the S&P. We'll go over a couple of the main indexes just to see where they're at and what that could mean. Look at the ASX, and then I think it was Peter who was just questioning a couple of questions about. It was probably a good talking topic about risk as opposed to stop losses. So we'll go on a bit about that, and I'll give you my theory behind it all, and why. It's really about stop loss placement. should you have a fixed stop loss, a dollar stop loss, all that sort of stuff. Or I always look at the higher lows, lower highs. I feel that your stoppers has to be in a place where you're going to get it. If you're wrong, um, then the market's proving you wrong, not stopping you out before it proves you right. So I think there's different cases, and we might have spoken about this before, but I think we'll go over a few things. So feel free to chuck in some questions as we go along, and I'll try to bring up a couple of examples of where stop loss placements actually important. I mean, you can see one. Actually, not just yet. Yeah. So we'll go through that in a minute. Now, what else I was going to do? And then we'll just open it up as per usual. Open up to a couple of questions. Anything you want to have a look at, feel free to chuck into the chat. Now, to kick off with, let's just go over the markets. What we've got here is a Dow. And you can see the Dow's just powering along. That's a daily chart. Their all-time highs were back here. You had some resistance to clear, which we cleared that quite a while ago. That was back in July this year. But the whole time, all through this bearish talk and the world ending, the market's just been consistently holding higher levels. So, we had this bit of a washout here. Was it coming to the June? Yeah, June this year. Bit of a washout of, we had this big bounce from Christmas, I think this was. Yep. So from Christmas, this big bounce back up to the highs. In all honesty, you're going to expect some sort of reaction off the highs, and it's just people who bought it up off this low, coming into Christmas or start of the new year, whatever, have just locking away gains, pure and simply. The fundamentals don't change. The macro view wouldn't have changed. I mean, all the talk that's been plaguing us and plaguing the markets for a while, even though it's making new highs of, trade deals falling apart, Trump's been dodgy. Now it's, what is it now? His impeachment. There's always something negative, and you remember, negative news sells. Positive news doesn't sell that well because no one really cares. It's all hunky dory, but fear will drive the markets, or will sell. So as long as they're talking up that, and it gives fuel when everyone's fearful. Sometimes it's probably the best time to be a bit more enthusiastic, as in it just means that the bulk of the market's facing one way. What if they're all wrong? There's going to be a good rally. But if they're all right, the market could barely move, if that makes sense. So if you've either got people, if they're fearful, they're either out or they're short. Two things. So, but if everyone's got the same type of consensus, or they've been trained to believe that same mentality or have that same mentality, then you're not on the fence, you're off, and you're biased one way or the other. You're biased short, potentially, and if the bulk of people bias short, and they're either positioned to take advantage of that. What if they're right? The market tips over. Look, maybe the market doesn't move that much because it's got to be fresh selling to push it down. And if everyone's biased that way already, what fresh selling is ready to come into the market to push it down? But if you got people that are on the sidelines that think it's bearish and it suddenly turns positive, bullish, then that's fuel to come in. And also the people that are positioned short, it's fuel that they have to get out and push the market up. So it's like the path of least resistance. It's a hard one to get your mind around sometimes. It takes me to explain it to myself quite a bit to make sense of it. But the path of least resistance is up with regards to fuel. And everyone might be thinking, okay, we're all bearish. The news is all bearish. US has got problems with headwinds, China, Hong Kong, whatever they were. But it's about fuel in the market. So if it's a known quantity, we all know it. We've reacted to it. It's the unknown that we still have to react to, if that makes sense. And that's why this market has just been plodding along. I mean, the amount of people have probably been bearish, so I'm going to cash, I'm going to cash. They said it a few times, it pops up. Okay, we had a good rally. Okay, we're going to cash. This is the one. Okay, this is the move. And all it's doing is holding, we'll just use this one, holding a higher level, holding higher levels here, higher levels here. You can just see another higher level. So it's just constantly picking people apart on the long side. So in saying all that, you're always going to get these reactions, and it's hard and fast to get soaked up, hard and fast getting soaked up, creeping back up to new all-time highs. So I think it was last night the market traded into new highs on the Dow. It didn't close into new highs, but it's still well and truly a well-established uptrend. You've got to be questioning now. I mean, obviously, are we due for a reaction lower? Maybe coming into Christmas, maybe the news has come, it's now become the known with regards to trade. They've still got a phase 2 trade deal, but it's taken a lot of heat out of that bearish sentiment. Is there going to be a lot of people on the sidelines ready to jump in now that phase 1 is off the cards, or who's positioned where? So we're still to see that yet, I think. But the market's well and truly up. I would say it's stretched. If you go and look at the broader market on the US, that is well and truly stretched, but don't think because it's stretched it's time to sell. I mean, it's time. I always believe in taking partials into a stretch market, but to close out completely, it means you've got nothing left into the market to take advantage of if it moves up. I mean, there's the risk that it turns around on you. That's just fair enough. But you just got to be careful that, I mean, if you go to cash completely because you think it's stretched, and say you did that back here into the highs, if you can see just here that market was, well, it's not really going to work, but anyway, you project that down, the market was stretched on your stochastics in overbought territory, the momentum's up, you come into the highs, you take it off, and all of a sudden you see it rally, what's that, another 170 points on the Dow, the big S&P, which is massive. That's a massive rally. So you're left on the sidelines with all this rally, and then potentially you're buying it up here, or you bought, you see this pullback, you expect more. But the price action doesn't suggest that it's weak at all. It's still very, very strong. You get the market pressing higher this whole time. Does that make sense there, guys? Just what I'm talking about in regards to fuel. But this, I mean, I guess the point I'm getting at there, it was that it is stretched, doesn't mean it's pulling back. Okay? It means you have to wait for the market to show that potentially it's going to roll over. We might be looking for a double top. We might be looking for a lower high. These sorts of things. And that's a sign of weakness. And then we have to assess it as we go. Say, for example, this little pop down through here broke the anchor, but it finished basically at it. So if you're looking for an end of day break, it was intraday break. It's open lower, tested lower, and finished basically right at the anchor for this uptrend. So, do you judge whether it's broken or not? On an index as such that you can't trade, potentially that's not broken because it hasn't finished below it. But even that, as a bit of a heads up, what you'd be looking for, whoops, just get rid of this. Sorry, what you'd be looking for is like a lower high to come into play, and then that kind of action. But it didn't. It just continued to tickle higher. I mean, you've got the market press through the highs. It sort of stalled below, pulled back, made a lower, higher low here, and then straight through it. So yeah, there was nothing here. That was your heads up that potentially we're going to roll over, but we know how the market's been the last probably last year. It's news driven completely, and I guess through here you just start to realize that you're going to have Trump support without a doubt. Every time the market works top heavy, potentially rolling over, he'll come out and start supporting it right on the open, prime time, saying that things are going along swimmingly. Look, maybe he was right the whole time, just trying to give the market a bit of a warning. The market's taking it that way, going, well, look, if we can't head down, what else can we do? We're going to go up. Simple as that. So yeah, long story short, I'd be still biased up on these. I mean, you're still going to be biased up until the market turns and it's either going to correct, and it's the biggest problem. The fear of it correcting hard on you is always going to hurt some people, but you've got to trade it. You don't guess it, you just trade it. And like I said, if you got out here, you've left a lot on the table. When it was stretched last time, it's continued to be stretched in overbought territory. This little pullback here, quite a bit of heat come out and some sellers come in. It got soaked up again, with this little spike lower, and then bang, up we go again into new all-time highs. So this is the S&P into new highs, closed into new all-time highs last night. NASDAQ got the same sort of structure, still continue on nicely into new highs. Again, it's getting stretched, so it doesn't mean close. It means be wary. It means know where your stops are, know how you're going to react, and know what you want to see if this market's going to roll over. Because the only worry you have to have now is your risk management. It's not where am I going to get in because you should be in. It's not. It is where you're going to get out and how you're going to protect yourself, and what if you see scenario A, what am I going to do? If I'm going to see scenario B, what do I do? It's easy if it keeps going up because you don't have much to do at all. But if it starts to roll over, that's the hard part, the tricky part. What are you going to do? You're going to know that pre it doing it. You don't want to be caught on the sidelines, figure out what's going on. You want to have some sort of plan of attack. So again, I'll be just looking for stuff like this. If you start to retest this lower, and then start to fail, chop around a bit, and then ideally what you don't want to see is these lower highs come into play. Maybe a wash out of the highs. You start to get these sudden shocks down and then followed by a real gradual move up. Maybe you get this lower high coming into play as we're in the overbought territory. That lower high generally is going to mean some sort of change in trend, whether it's sideways, consolidation, or at least some heat. The higher it goes, the more heat's going to come out of that action. So you would expect a bit of a pullback. and then you've got to judge what's happening. What kind of pullback is it? Is it a major pullback, minor pullback? And we can't do that until it starts playing out. Right, that's the Dow. We'll go into the DAX. DAX is right up in all-time high territory. You can see back here in, what was that, Jan this year, and November last year. So we had that initial test in the highs in November, retested highs, and then we failed, pretty much the market failed miserably after that. I've got lines everywhere, but don't worry too much about that. This is what I was looking for. That's right. Let me just get rid of some of this stuff. Actually, let me just clear it all out. All right, so you've got the market, which is traded up into these highs. It's been up there previously. We're getting up there now. Had a good night last night, the night before. On the DAX, there is potential. I don't know for sure, and I'm just hesitating. I'm just guessing at this. A lot of the action's been in the US. It's been outperforming on growth. Now, if you start to take the trade heat, which has been hurting Europe as well, out of the equation, and it depends how much is factored into the US, into that market where the current highs are now. Is it a bit of rotation out of the US into Europe? We don't know. I mean, we might just have to watch that. We are at highs, whereas the US has traded well and truly into new all-time highs. What happens with Europe, we don't know. But there could be, if there's a lot of US dollar selling, that means they're probably edging out of US dollars, potentially locking away some gains into equities, taking some heat out at these highs and looking for other areas for yield. Like I said, don't know. It's just we've got to think about all these things and then search around. And that's what, you've got fund managers and everyone like that. The bigger money, it's just a flow of money looking for yield. Big flow of money, massive flow of money actually, when we talk about it. So that's the DAX. We are at highs. It doesn't mean we're going to fall. It doesn't mean we're going to rally through. All we can do is say, all right, this trend is up. Major anchor down here to this leg up. You've got these minor anchors down here. It's sort of, another minor anchor down here, holding the trend up. So really, okay, what are we doing? We could extend high. We could keep going high. So intraday, you could be trading it. If you're not long, if you're long some, then just look at the index for a bit of a macro view. If we roll through this anchor and then start to hold a lower high, maybe retest those highs. So we could be doing on the DAX something like this, come back up, retest the highs. That's a double top. And then you ideally just looking for your lower high for weakness anyway. And if it doesn't, if this holds up, we could jam through it. We could pull back. We could contract off the highs, consolidate again, like a major sort of a correction, and then jam straight up through the highs and just keep trading higher. I mean, there is that obviously that possibility, but the trend is up at this stage. But we are, as opposed to the US, which is in clear skies or has clear skies, on the DAX is straight into a key or all-time highs, previous all-time highs. If we go to the FTSE, I think they've just broken out a really shabby range. Here we go. So that's not a bad sign for them, but you got to remember this was a trend up, retested the high, or we made new highs, pull back, cleaned out a few of these higher lows, retested and failed, had a deeper pullback. So that's a major correction, and then we've gone back up to retest those highs, pull back. I wouldn't say this has broken any anchor. So if you look at this, that there's more that buying zone. We start to lift up off that buying zone again. So there is the potential that if this is the leg up and we start to match that, or we're looking to match that move up on the FTSE anyway, that could take us right up to 82.55. What's that? 700 points from here. So there is the potential for this market. It's built a base, spent a lot of time building a base with Brexit as a problem, as issues that they're facing, and that's potentially sorted out. Not yet. Who was it? Boris, good old Boris won the elections, or his party won the election pretty convincingly, which gives him, I think, majority in the House, which potentially high probability can push through Brexit and just leave the EU. So it'd be interesting to see how that goes. I don't really follow it as such, just that, following currencies on different, or following the markets on different news and what's happening. And the pound was it took off as soon as he won the election. They're sort of factoring in, or they're trying to think ahead about Brexit and what that means. The funny thing is, normally a high pound is pressuring the FTSE, yet the FTSE's just rallied as well. So I think it's well undervalued. You could suggest that it's well undervalued on the FTSE. And now with a few headwinds taken out of the way, they can start. You might be a lot of corporate or company, what do you call it, investment that could start to lift because now they're starting to get a clearer picture of which way they can head. A lot of the roadblocks have been taken out of the way, or they are going to get taken out of the way. So business investment might start to pick up, which means it's good for the economy, generate inflation, all that sort of stuff, which would push to higher levels on the FTSE, even with a higher pound. So that's my reasoning why we're probably going to push up into new highs on the FTSE sooner or later over the coming days, weeks, months. We'll just have to wait and see. So that's it. Let's go to the ASX now. Big day yesterday. And what are we up? At the moment, we're only up 3 points. So it's a bit of a rough day today. It didn't do too much. We managed to take a partial. It's got knotted down on MGX at 95 and it's at 92. So there's a lot of these stocks that are kicking on the open and then fading midday into the close, and then they open up stronger, then fade. So it's just a strong open fade, which is never that good. It's selling into strength in a way. So, where am I? I want to remove that as well. So there's not much to say about that. We'll just smack up into the highs. I thought we might have traded into highs today, all-time highs today, and take out that and just trade into new all-time highs. It'll be interesting now. There's no doubt this market is heading higher. It's got room to fall away from the highs, but still keep the overall trend up. And it can drop, say, 200 points from here, not a problem, but still maintain that longer-term uptrend. And this is the daily. The daily we're on. So we can still, you can see, bang around here quite a bit, fail off here, push back down, and then start to rebuild and work our way back up to the highs, maybe trade through the highs, and then start to fail all the time, maintaining this uptrend. So it could still be a sticky, rocky road, I guess, going ahead. But I don't think we're going to be into some established trend like we saw, what was it, up until June this year. Just yet. I think we need a few more details to make sure China's all happy and dandy on the phase one, and then start getting into phase two deal and start to work that out. And I think it's going to be really supportive of our market. And also probably going to be supportive of our market is potential rate cuts. That's we'll have to wait and see how that goes. But there is talk of further rate cuts from the RBA, which freer money, should support growth, inflation. That's the theory, I guess. We'll just see what the market's factored in, what they haven't. Any thoughts on the ASX? We start getting into a bit of a talk about stops. I'm still bullish. I think, we could be getting a bit stretched up here, but we're not technically stretched. We're not in overbought territory on your daily on your stochastics the way I normally look at it. Momentum's kicked up. We had a big day yesterday, and it's probably a bit of a pause today. You might find some heat comes out of a couple of days, and then up we go again. But we'll just wait and see. Any questions there, guys? Am I coming through loud and clear? I'm hearing funny. I'm hearing funny noises in my head, but it's through the earphones. Let me just quickly do something. Still all good. Yep. All right. No questions. We'll just all good. Perfect, Pete. We'll get into it now. What I wanted to do, I might have some stocks here I can just play around with. I want a good example. That's Mesoblast. I think MGM was pretty good. Yeah. John, g'day, Rio. We'll have a look at that, mate. Actually, I'll go over here. What I'll do is I'll get up. I might see if I can just focus in on this run up here with regards to stops. Actually, no, I'll talk about two things. So we're just going to stick to one chart. I won't be jumping around. So my idea with stops and stop placement, or that to me, risk and stops are the same thing. you should be placing, ideally, I believe, you should be placing your stops where the risk of being wrong is. Not you don't think risk in terms of. I mean, I like to think risk in terms of being wrong. Okay, because your premise can be right, and I know a lot of times, I know a lot of people that just they wrong, incorrect stop placement leads them to getting stopped out, and their premise and their research or their planning for the trade is completely right, but they can get stopped out. And there is obviously the other side of the coin where people just don't bother taking stops and they don't understand risk, and then guarantee if you don't do that, you get chewed up. Sooner or later, you might have more profitable trades over time because it's just a waiting game, especially stock traders. But then they start filling the bottom drawer with these rubbish stocks that they just got in the habit of not worried about risk, not knowing where their risk is, and not taking your stops when you're losing and thinking it's going to come back. I mean, you just got to realize that you're not always right. You don't know everything. No one knows everything, and that's what this game's all about. We don't know. You could be completely bullish, both technically and fundamentally, on this little green candle here, this breakout candle, and then you go, look, this is just going to keep going high. We're looking at $2. I'll get out at $2. What's your risk? Don't know, because it's going high. The fundamentals are great, and all of a sudden it turns around, and then you spend the next year trying to get back to break even. You're nowhere near back to break even if you were buying in this section here. So you have to know what your risk is if you're wrong, and you've got to admit that you're not always right. Let me just transition that. So I just had to change the chart. I couldn't see the right-hand side of the chart. Does that make sense? So regards to risk, I want to place my risk, whether it's dollars, my level has to be where I'm going to be proven wrong. It's not. I don't want to place it with regards to, okay, I'm always going to have a $200 risk, and I always take 10 grand position, say, okay. Or it might be, so that's, I don't even know what that is in percentage terms. I might always take a 5% risk. That's all I'm ever going to take, because that's what a lot of people are taught it that way, which is, it's a good approach, but I think it's not the best approach. I think for me, I've always found that, like I said, putting my stop and my risk is where I'm proven wrong, and then adjusting my dollar value risk to that. Okay, say for example, I'm guessing you all know, we've spoken about this before, so that's the uptrend, and then we've got this kind of move here. I know that's my anchor. If I'm proven at this stage, if it goes through here, I'm proven wrong. So I'm waiting for my entry, and I might go, okay, everyone seen me draw that before. So what I'm looking for, if I get this pullback here, and I get this, and I think, okay, that trend is still up. We've had a decent enough correction there, but it's still holding that trend, still looking great. And we start to lift. I know as soon as I break that high, I want to be in. Okay, and I know exactly where my risk is. It's going to be here. It's not here. It's not just arbitrary dollar term. That's where my risk is. So looking at that price action and trying to take into account, and this is where what we're doing by, it's more got to do with the setup. So the setup for me, the reason why I like that setup is a high probability. It's showing me that this trend is, draw it back up in the red. We might have had this price action many times, but basically, basically this overall in red, the trend is up, and it's only broken when you break the anchors. And until we break the anchors, the trend is still holding. It doesn't matter what happens, chops around here, and that's just made to wash people out, put the fuel back on the sideline, ready to get back in later when they realize they're right still, and they start chasing it high. And that's how you get the markets continue to move higher over time. So the way I'm looking at this, I'm going, okay, that trend is up. We've had a couple of legs down, and I know that if we get a higher low, I'm expecting it in this zone, say somewhere in this zone, for buyers to start stepping up, because it's a perfect spot longer term to build a higher low here, and a higher low. So previously, we've got 1/3 to 2/3 retracement of what I'm looking for, of that leg up, 1/3 retracement, maybe 50% retracement. Ideal spot, for whatever reason, the way I've analyzed it, ideal spot that if it's going to turn around and continue to be bullish, that's where it could do. That's where it could happen. So I'm just preparing myself in advance to take action. And this is what I want to see in blue. I want to see a higher low starting to build. And a higher low just means people are starting to get in earlier. there is potential. That is the zone. It's starting to happen. I'm starting to see the price action play out. And the only thing you have to worry about from there is risk. Where's our risk going to be? And my risk is always going to be below the high low, because I think if I get stopped in, say yellow, if I get stopped in with a break, well, that's not a very good color you can see, is it? Let's go green. Green. So if I get stopped in with a break through this high, my expectation off this higher low that this is all going to be part of 1, 2, 3, another move up, right? So that's the expectation. Now, if I get stopped in here, I get long, and all of a sudden it turns around and stops me out, takes out that higher low. Something's not right. You know that something not. That could be just a pure washout, and then we get in this major correction, and it just takes out the anchor, and then game over, and then you can forget about it. But what I feel is that higher low leads to, if I put all my, I've studied it right, I've analyzed it right. I looked at my weekly chart is maybe one leg up, two legs. It's in a prime position on the weekly. The daily's looking great. Everything's matching up. You got confluences everywhere. Then that's my entry, and I take that entry purely because buyers are stepping in at higher levels to produce that higher low. In anticipation, we're going to take out the high and continue on up. Now I've seen that more often than not. That setup leads to that price action playing out, but I still have to know where my risk is. So I don't care what pointage value, what points that risk is, but when I get this price action, that's all I'm looking for. All right, so I know that's where my risk has to be. So that's how I would determine risk. Now, with regards to a stop loss, that's exactly where I'm going to place it. Right, my stop loss is going to be below there. My entry is on a break above. It's simple. So all I'm really doing from there is working out the distance in cents terms or dollar terms, and then I might have a $1,000 risk on that. On every trade, I don't want to lose more than $1,000. Okay, so that might mean that this position I take a bigger position than normal because it's quite a tight stop, or the risk can be quite tight. And there's other times where you might go, that's quite loose risk, but I want to be stopped out there, so I still only want to risk 1,000. So I have to work it out how many shares I can have from there. So you can put that in a spreadsheet, and you can just work out the numbers quite easily. But I would never put a stop, risk 100, risk $1,000, for instance, on that trade, and that stop brings me above my high low. And that's where it comes down to, okay, that's where I'm taking a $10,000 position size every time. So if you take that approach, I'm always taking $10,000 as a position. That's where my risk is going to be. Sometimes it could be below the high low, sometimes it could be above it. You don't know. It all depends on your difference between your entry and exit. Does that make sense? So that's the difference. I think if you work off a position size in dollar terms and you always use that, then you're going to have times when your risk is below. I mean, and there's no reason why the market can't stop you in, turn around, stop you out here without breaking that risk level, and then turn around and just go to all-time highs. I mean, there's no reason why that can't happen. Then you watch it and go, all the hard work I've done on the entry, working it all out, knowing where I'm going to put my risk, where I'm going to be proven wrong, and I get stopped out, and I was never proven wrong once. And I've done that so many times intraday as well. It happens on the SPY. You watch it and you go, okay. And it's generally, for me, it was on my exits when I'm in profit. Don't really have too much of a problem taking it on the downside, but when I'm watching it go, I was never proven wrong and I closed it out for some reason. So I'm never proven when I'm in profit that the market's turning. So it's just as you want to make sure that you're proven wrong, I guess, is the key point to take out of this. So does that make sense, just what I'm saying there? So that's why, sometimes I might have I've got a max $10,000 size, position size, for instance, but that could be lower. That might be $8,500. That might be a $9,000 position size, depending on what size risk I'm taking. So I want my risk to maintain, I want my risk to be the same all the time. The dollar value risk, not the dollar value position. So sometimes that could mean that you have a bigger position size than 10 grand. Okay, so be it. It just means that you're still taking a smaller risk. So you're not ever going to lose more than what you're willing to outlay each time. And if you do lose that, then you guarantee that you're proven wrong. Well, in theory, you're proven wrong. I mean, no reason why this can't stop you out below that risk and then turn around and barrel up again. I mean, that's happened again, but it's just a very low probability thing to happen. Does that make sense? So if we go over to, it's quite clear your different setups. If you've got a continuation trade, I can just draw that there. And so we can take a snapshot of that. So what I'm always doing with charts and levels and working them out is just continually working out where my risk is going to be, where I want to place it. And then the last thing you're doing, once you've got your entry level, your exit level, if you're going to be wrong, then you're just working out how much I want to risk on that trade, or how many shares I should be buying, how many CFDs I should be buying to get into that trade. It's the same. You can do the same sort of thing with currencies, because now you can trade on CFDs, dollar per point, all that sort of stuff. Yeah, look, it's not the lazy approach as such. It's probably just something you're used to there, Pete. But I think I just think about it in terms of what I want to risk. I don't care how big the position size, because it's going to work out. I mean, if you think about it, it's going to work out an even. I mean, you can cap, so you can do two things. You can say, I only want $1,000. I'm going to lose, and I only ever want a maximum risk of 10 grand. Right, so it's going to be, and if you do it that way, that means you're only going to have a maximum 10 grand position, and you only have a maximum loss of $1,000. But there's going to be times when you got such tight risk that you're still risking $1,000, but your position size could be bigger than normal, bigger than 10,000. It might be 11, 12,000. And I think if you take that approach, where sometimes it's bigger than 10, sometimes it's below, overall, you're probably going to end up with the same results over time, because you're going to have your same stats, maybe 55%, 60% right. So there's going to be times when you've got a 12,000 position size and it goes like the clappers and you have a really good return. There's going to be time when you've got a big position and you're going to lose your $1,000. But I think over time it's going to work. If you keep capping it at 10,000, your good trades are only going to be on a 10 grand position size, but you're always going to take $1,000 loss. Does that make sense? And you might have a trade where you've only got a position size of 8,500 and it rallies hard. So if you can imagine that 8.5 position size, and then you're taking a max loss on a 10 grand position size, you want them to work out. So that's why I would prefer to use a dollar risk value than a dollar size value as my starting point. So really, I mean, if you're going to say trade this, when you're trading a breakout here, you're trading the break there, your risk is, below. That's what we call I think I've talked about it before, about boxing up your risk. I don't know if I've mentioned it too much, but you box up your risk all the time. And it's just what we did with that last, if that's the market's rallied up, we're pulled back. I go, if I break through this high, I know exactly when it breaks. If it breaks through there, I want to be in. I don't know where my risk is just yet, because it hasn't turned. It could keep going down, and then go. So you don't know if it's, if your risk is going to be here, here, or here. That makes sense. So as soon as it starts heading higher, you go, okay, the closer it comes to your stop, the more confident you are. That's exactly where your risk is. Then you can work out all your stats. You can work out your risk in dollar terms. So once you start getting that play out and it starts to rally, we call that boxing your risk. So you know exactly where your high, your entry, and you know exactly where your risk is going to be. You've boxed it up, and that's just a matter for that to play out. I think $1 million fixed dollar risk. It would be interesting to look. There's probably going to be times, if you did have always a $10,000 position size. I guarantee you there'll be times when you stopped out, but your trade doesn't prove you wrong. And there's going to be times when you also stopped out earlier, if that makes sense, and then your trade is proven wrong. So if you have a 10 grand position size and it makes your stop, so it means you're always going to lose the same amount, whether it be 1,000, but you work out the number of shares on the 10 grand rather than your $1,000 loss. There's going to be times when you stopped out here, and that's where I'm just trying to think of a good example. Say here, that's where you're proven wrong. On the break, you took that and it turns around, but your stop is here, and it turns around, takes you out of your stop, and it keeps going down. So you're taking sort of a smaller loss, I guess, if that makes sense. But I think from what I've learned, I feel the better I've got at calling the markets, the better I've got at picking a good entry. the more likely I can find chop. I get caught up in a bit of chop before it goes. And I could easily be proven wrong 3 or 4 times before it goes. Sorry, not proven wrong, but I could have been stopped out if I had that approach of um, a set dollar amount for position. That makes sense. So there's nothing here that would probably stop you out as such. But I guess I think you get the gist of what I'm saying. Does that make sense here, guys? So what we're talking about, boxing up risk, that for me, as soon as it breaks through that high on this green candle, you know exactly where your risk is going to be, below the high or low. And then you're just doing that over and over again. I mean, there's a few different entries here. You've got an entry here. You potentially got an entry here through the high with risk, and it plays out. There's other ways to trade too. You can trade off a couple of green candles. You can tighten it up a bit, but you're still proving out below the high or low. There's all these sorts of ways to trade. So you can see that if that's, whoops, so I draw that a bit clearer. If I'm trading it at this point, I might go, well, getting through that high there is clear for me. It's starting to break out. This is contraction lower. The trend is up. We're holding higher lows here quite clearly. I've boxed up my risk. That's my risk level. Here, that's my entry. All right, nothing wrong with that. We turn around, it doesn't go anywhere. You might have taken a break-even trade here, or you might have just taken a stop on this move through. Depending on how you manage your risk once you're in. But there was nothing wrong with that entry. It just didn't work out. All right, and I don't know. I think the market rolled over from here. Was it MGX? Yeah, it rolled over from here. So, if you didn't take your risk here, if you didn't take your stop when you were proven wrong, which is quite clear when you're proven wrong, and you got this market rolling and failing to get through highs here, 1, 2, 3, and then this is, I don't know if you can see that green candle followed by a red candle. It's a very minor lower high, leading essentially is going to lead to lower prices. You don't know where it's going to go to, but if you happen to tighten your stop up there, great. If you didn't, in hindsight, when you're looking at this whole market rolling over, yeah, you got out of jail pretty good then, when you would have probably been stopped out above $1.10 that went all the way back below 70. You'd rather be out reassessing and then buying in, potentially where we did at 82. And if it gets back up and retests $1.10, then great. You made a gain on the 2 trades. Overall, you're up. Does that make sense? All right, so I think we've gone through, explained what I mean, the difference between your risk and your stop, and knowing where you're proven wrong on any one trade. You've got to know where you're proven wrong, and then work your size around that, but making sure that your stop is going to be where you're proven wrong, not arbitrarily because it works out to be a $200 loss or a $1,000 loss, or if you're massive trader, a $5,000 loss, because you're always happy to take a $5,000 loss. I think statistically over time, I've always found that if I put myself in the right area, longer term, I'm going to get better results. Okay, so that's, I think, what works for me. So the trade we've got going now, the entry was here, and that's the first signs we're starting to hold. We've moved right down, flushed that low there, popped up. So going through the explanation of what just talking about at that stage, this is on the Mount Gibson trade. You can see the market was down. We've got to this low, and at that stage, when you hit that low, this is about where your anchor is. You can see down, up, down, up, down. We blew out down to what, about 62 cents, straight up through the anchor. So as soon as you get through the anchor, you've got to question, is this trend still down? What are we going to do? We're going to consolidate. We're either going to go sideways or back up. 2 things. Or, you go back up, you might have the leg like that, then start to roll over. But either way, it's a change in dynamics. So at that stage, we got the break, and then we started chopping around, really not getting back down to this low. You go, fine, another leg up, break through that high. So then you got to start seeing it. Then the MAs are starting to cross back up, and we're starting to sit on top of the MAs. A bit of volume here, good volume here. Well, later on there was good volume. But at this stage here, when we entered, you can see that that's the entry. It should be quite clear. You're starting to see, okay, we've been in a downtrend. We went sideways for a while. And we're starting to lift. Now we're sitting on top of the MAs. When you're sitting on top of the MAs, it means the majority of people are buyers. The majority action's up over the last, 20 and 50. So the last 20 candles, it's turning positive. All right, so that's the net thinking of people. The bias of the majority of people is up, not down anymore. When you're below the MAs, the majority of people are thinking lower levels. When you're above the MAs, the majority of people are thinking higher levels. Right. So as soon as you start seeing that, then it's really, you can see the entry through here. We broke up through, so I know where my risk is. Hasn't been hit yet, and we started to take off. If we started to pick up a bit of steam, well, that was basically when ahead of the China talks, when they're starting to look good. So at the moment, all we're really trying to do is assess risk. We've got 95 as a partial, which is about 14%, and we're really just looking for an area to manage our risk. And I think this is another point you're saying, Pete. Our risk really is going to be down here. It's roughly about just slightly below. I think we've got it at 80 now from today, or 81, slightly below that higher low. And I'm happy to tighten it up. And that it is below a higher low, not a key high low, but we're close to entry. I mean, no one wants to see it drop, get stopped out, and give up another 14%, for instance. It's a tough going, but if you're going to follow the trend and see how much you can wring out of it, then yeah, there's going to be times when, okay, this is a high, bank straight down, you get stopped out. But more often than not, I find if it's gone hard like that, you're going to start to get lower highs come into play. And then if you get a lower high come into play, you can just move your risk up, straight up, done. Exit, lock in a bit more gains, and then away you go. But I think you're going to get a chance when you get the outside chance it just falls over. Yeah, and that can happen, and it gives you the irrits, but that is trading. I think if you start to go up here, which I've done it more, a few times as well, go by the candles rather than a higher low. Your daily candle, let's take it the break of, let's just take that off. Let's take it the break of, say, of 90. If you moved your remaining stop up there, there's no reason why I can't have a pullback, stop you out, and continue on up and trade all the way back up to the highs at $1.15, 20. How much are you left on the table then? Because your stop placement, it's the same as when you enter, what we were just discussing about with regards to your risk. It's the same theory. You're not proven wrong there. All it is, you're just trying to, for, I guess, lack of a better word, fear of giving away too much, that you tighten your stop right up. Does that make sense? So that, to me, is incorrect stop placement for the remaining, especially your remaining part. I mean, if you don't take anything off up here, then yeah, you could just have a full position, tighten it right up, and then run the risk that it doesn't turn around. Actually, it doesn't keep rallying without you. But I think if you take a partial, like we've done, I'm always happy to take a partial when you start to get a bit extended and you've got a good gain locked in. Happy to take a partial because I know that sooner or later, not just me, but others are going to think the same thing. It's gone to, I don't want to lock away some. I want to either get out of a full position or I want to get out of something. That's the theory. The higher it goes, the less people want to see gains evaporate, and the happier to take a gain, something off the table at least. So then you get the bias swing from going up to going down. Doesn't mean the trend is over. It just means it's a good little time to take a partial, and then try to run your risk at a correct, it's probably arrogant to say, but correct risk management below a high low. Because if this breaks, I'm proven wrong. Something's fundamentally changed. But here, nothing's changed. It just could stop me out and turn around and keep going. And when you do that and see it keep going, I don't know if anyone knows the example I had VRC. I'll see if it's still there. Just got to find it. Now, I had VRC here. That's right. So if we can drill in that, I had VRC. It was up to 5. So we bought it. I think I bought it personally. And this is how, just talking about stupidity. Watch it up into 5, took the full position off, went straight through, pulled back to basically where I got out, and then took off. And so that could have gone from, I think it was a 50% gainer or something like that. So it's good gain to being a 300 or 400% gainer. I mean, that was just the difference through incorrect risk management. And this was a few years ago. This was back in 2016, 17, something like that. You can see that move, when it did take off, I wasn't on board and I gave up a lot. I got out around 5, I think, 5 cents from, say, I think it's 3.9, 3.8 or 3.5 maybe. Somewhere in here, I think I bought it. just before this. So I rallied up here a bit. It's pretty hard to see still. I got in as it was going up here, had a pullback, got up to 5. I took it off, finished, closed the trade, thought I was a legend, and then a few days later, you see it just go all the way back up to 14. So even at 5, if I got in at 5, that was close to triple my money, at least 200%. So from where I got in, it was probably more than triple, more than 300% gain. So I left 250% on the table at least. So that's what I mean by incorrect risk management. It's just as important when you're getting in as when you're getting out. All right, so I've been yabbering on a bit. I'll get on to Rio. If there's any questions, just whack them into the chat. If you've got something you want to have a quick look at, probably about 10 or 15 minutes, whack it in the chat. Well, is that what happened there? Best. So Rio, there's nothing to argue with. It's going up. That's great. This has been a good little buying opportunity. You can see this, especially after we made that high low. So if we can drill that, just quickly check something. All right. So it's coming up into a level now. When you look at the daily, we're coming up into these highs, but there's no reason why. I want to do a couple of things here, longer term and short term. This is what it's important to. That's what we talk about, multi-time frame analysis. Sounds great. All it really is just checking charts, checking different time frames to make sure that you're not missing too much. Excuse me, I'm starting to get a bit of a croaky voice. So looking at this, you'd be going, okay, we come up into this high, I might want to close out. We've done it right. We bought it in here. You might have bought it just on that green candle. Risk is down here. Yeah, all perfect. High, low here, off this low there. You go, that's great. I'm going to take it off when it gets to, what was it, 106? I don't know. So it's 106, whatever it is up here. Take it into that resistance zone, maybe a bit earlier. Make sure I lock it away. That's great. Nothing wrong with that trade, but you just got to remember this is, if I can just take this back, I just want to see if it does work out. This is a monthly. Just by looking at this, we'll just go to a weekly even. There's levels just further up that it could easily push through. What have I done? All right, so you've got you've got a clear resistance when we started this leg up here off this, around, was it $70? So that's your leg up there. If you can extend that up, they're probably, roughly even from low to high. It takes you right up into this zone up to around 120. So if you're looking to close it out at 500, 506, you're leaving, it's not a big percentage terms, but you're leaving 5 or 6, 7, 8% on the table, potentially, just by not noticing that this leg up on your short term, on your dailies up, but also on your weekly and your monthly from way down here. You can even add to that. You've got a massive move up off the GFC lows. Now, I don't like this chart, but if you take that, it probably takes you somewhere around these highs as well, from low to high. And this is just, this is all just sort of technical theory. We're trying to figure out where it could be going to. So this is what it comes down to, just your analysis and how do you structure your trade? What are you trying to do? Where do you think it could go to? Is there a chance it's going to fail here, or is there a chance it's going to keep going? And this is by looking at the bigger time frame monthly. You go, well, hang on a sec, this all looks quite good. Good correction here, and we're starting to build. It doesn't mean we're running out of steam when we get up to here. We could be just building. This is a high low, just below 85, high low, all of this leg up. This leg up is not broken, and it's not broken until we go all the way down, say $70, break through this level. But you can see that to me is looking like it's going to go straight through those highs more than anything else. Does that make sense? Straight through this high, around, so you take it off, we're now 103, you get another $1 up your sleeve, another $1.50 up your sleeve, and you take it off here because you think that's the high. Longer term, on the weekly, it is looking extended on the daily. We could have a reaction lower, but might just react lower, reset at the MAs on the daily, and continue up on up. So for me, Rio looks quite strong still. Of course, it depends on what sort of position you got there, John. Have you taken some off already? Where did you get in? Did you get in, down here? Did you get in down here? Did you get in on the breakthrough 97.50, say? Did you get in at $100? If you got in $100, yeah, you might have to wear a bit of heat if it does pull back to the MAs below $100, for instance. Where's your stop level? So all these sorts of questions, I guess you'd know, well, only you would know. But to me, we probably could get a reaction off those highs, pull back to the MAs on the daily, and go again. And that would match up to the weekly. There's nothing wrong with that. We can go again, reset at a higher level on the weekly, and go straight up through 106. Trading up to those, like I said, these monthly highs around 120. So it all looks pretty good. Is no position, okay. Well, then obviously just wait for a pullback. It is on the daily. If you're looking at the daily, you're not in. I don't want to buy it here because even though I said all that, it looks bullish. I would it's what I'm looking at it for is for a better entry, not to jump on board because I expect it to go through 106. Say it may not. I could be completely wrong. I jump on here and I take a hit when it goes back to $100 or below, if that's where my stop is. And technically, if I bought it here, my stop has to go at 92.50. Let me just guess where that is. We'll say 92.50. What's that? It's probably not much, is it? What did I say? 103. 103 minus 92.5 equals. Oh, that's really bad, isn't it? 103 minus 92.5 equals divided by 103, 10%. So you could take a 10% hit on that if you do get stopped out and you're completely wrong. This is a double top. But if it comes back, looks like it's finding support back at the MAs, then all you're really trying to do is box up your risk on your daily and see if that daily, weekly, monthly trend can continue up to the highs of $1.20. Oh, sorry, $120. So yeah, I'd just be sitting there waiting for that. It is extended. I would expect some sort of reaction up at those highs, but if it blasts through, I'll just go look for another trade. Simple as that. All right. Any more questions, guys, or anything else we have a quick look at? We're up 6.2 points, so we're flying today. A rough day on the old shares we have. Started off a cracker, and then they've all come back straight back down to earth. The ASX, I think, is notoriously or traditionally bearish. Everyone's scared to hold. Once they decide to get in, it's generally at the highs. Probably been cleaned up a few times. I guess nothing to laugh at, but bunch of bears. P&I. It is still insane. It is still kind of tough going at the moment. P&I is better on the weekly. I mean, that daily to me, potentially 450 is the level where it's going to hold. And you can see through here at $4, it's okay. We pushed down off the highs above 8, tested 4, rallied back up, got through 6 before we come back down and washed out 4, then started holding above. So we reclaimed, I guess you can say, reclaimed above 4, held above 4, and we started to rally. So this little move here suggested overall this move was starting to face back up again. We probably don't need to look at the weekly. But yeah, I have been looking at this one. I'm just not a big fan of investment companies. But anyway, so if you take it that way, yeah, and so that's pretty much what we're looking at. That suggests we put in the base at $4 and we're on the way back out again. So we're either targeting, so from there you really just go, okay, 3, 1, what do we do when we get up to 525 or this high? What do we do when we get up to sort of around this high, above 6? You can even take that back to, actually I would take that level. To be on the safe side, I always do something like that. When you see a couple of little highs like here and here and here previously, yeah, I may if I take something at $5 and we get up, I'll be looking at 6 rather than 625. If it goes through, then great. If it doesn't, if it starts failing at 6, like this previous level, look, I'd be happy to take a partial up there. But that's where I sort of put my levels anyway. And then you've got right up to 850. So they're your levels that you've got ahead of you that you have to contend with if the market's bullish. All right, so that's so far we're just planning out. I guess we're planning our attack now. If you take it back here, we're looking at this as being a high low. Okay, so we're looking at this level as being a high low. It hasn't proven yet. I think the last thing it has to do, as you can see, is if we can get up to $5. So we press up to 5 and we start holding this high level, bang, you've boxed up your risk. You know that this level is going to be a key high low. You've got a minor high low where you can box up your risk, knowing that we're starting to push up and out. So if that's the case, then if you take as your targets from low to high, and it's probably about the same up to $6. So really we might start to find some, initially with this move up to $6, before we start to have to worry about what's going to happen or managing our risk. Does that make sense how we drew all that down? So it's actually probably a good example of just breaking down of what we're looking for and what we want to see, right down to the entry. And the entry hasn't played out yet, but it really is the last piece of the puzzle. If we can get a high low off here, or at least back up through 5, I'd probably be happy to buy it through 5. If you've got a high low to work off, great. Otherwise, your risk is below. If you're going to buy it through 5, your risk has to be below, somewhere around 425. Maybe not. The risk is too big, and that's up to you. You can, like I said, if it's still the same dollar risk value, you just have to take less shares, to have that $1,000 we mentioned before, you risk. But if you can get this high low, it means you've got a bigger position size, and you know that if this gets you in and then gets you straight out and turns around, then it's probably going to take you at 425 anyway, stop you out at 425. So it just means that you've minimized the risk you're taking on it, and you're maximizing the potential gains at $6 in dollar terms. All right, I hope all that makes sense, but that was probably a good example. I think this one's going to be bullish. I think it's potentially setting up. Like I said, I just don't like investment companies as much. Probably being biased. I should just trade what I see, like I always talk about. But we'll see how it goes. I think this is the key. We're wanting to see low, wash out low, retest of the low, a higher low. Okay, so this is all what you're seeing when you see a market start to curve back up again. This is a key high low. That high low is confirmed when we break up through here, but we're looking for an entry prior to that. We're looking to front run that entry with something like this. All right, so I think that's a good little one. Keep an eye on that one, Sharon. VHT, let's take a look at that. And I know I was looking at this one too. Okay, VHT, we've been on this. Is that right, Pete? I think so. I'm sure we have. VHT, in October. In at 171, partial at 188, 195, final exit in November. So we just got smacked here somewhere, I think. Is that right? Or we got smacked earlier? That was probably another one where I stuffed up the exit, but it's turned out all right. When I get out at 195, so it was somewhere up here. I think I was on this little retracement there. Anyway, so this one, if you're looking at VHT, go back to the weekly. That weekly trend's up. Okay, and if you're looking at this, just eyeballing it, knowing that, okay, we rally up, pull back to the MAs, rally up, pull back to the MAs. We've rallied up, pulling back to the MAs. So if you think this trend is going to continue, prime position to start holding up, okay, to start looking for that entry. Go to the daily. Okay, what does the daily look like? I mean, don't worry about this too much because on the daily we're rallying up. That's your leg up. That's a macro correction on the daily, rally up, macro correction. But on the weekly, it's just a normal everyday correction, if that makes sense. So we're just going through that macro correction phase. So what we're looking to see, are we going to do something like this before we roll over again? So that's where I want to be proven right. Ideally off that higher low, like we saw here. 1, 2 moves down, retest that low, pops back up, higher low at the MAs, look to enter there. Looking for something similar like I think we got in here, if I'm right. 16th of the 10th. Yep, so it was on that green candle there we got in. And you can see we've had this big flush out down to the lows, started to hold a higher level. Okay, we're holding another higher level. We're just looking to preempt that break up to the top side. off high low. So you're getting that squeeze, and we bought it there, up she goes. So really, I'd just like to see, I don't think this has done enough time. If we can consolidate around here, 180, and we start to get some minor squeeze again, like we saw in here, higher lows, holding, potentially lower highs, it has to break one way or the other, down or up. But if you can buy it on stop on the break up, and then you know where your risk is because you can box your risk up better, then great. So I think at the moment, if we can just really drill down on that one. Key levels that I want to see potentially get involved. All right, you got volume is decreasing. This is not bad. We've got press down with the low. That's not really divergence. Divergence, you want to see a lower low here on price and a higher low on the stochastics or your RSI or whatever it is. But when you get them even, they could easily push straight back down. But when we're looking at price, you've got this kind of thing. Well, I wouldn't put it there, but I'm probably more inclined to do something like that. I mean, it's kind of messy. That's the problem. This is very messy, this action through here before we go to the low. But potentially, just go through. This is what we're looking at. Now, if you break through these levels at 175, steer clear because it's probably, that means this level is going to hold a lower high through here. If you break up through 187, then higher lows are holding. So you've got your sort of two levels, say through 187, and then I'd wait till it breaks up, retest, and then buy it, where I can box it up. Or, if you want to sell it, for instance, you can do the same, just flip that over. If it goes down through that level, pulls back to retest, and then look for your sell. And you're just boxing up your risk as well. Does that make sense? So really this one, they're the two key levels. I think anything between is a bit of junk, but I think something by looking at that, it could start to happen soon. And I'll be biased on the upside because of the weekly. So I wouldn't actually bother with this selling it, but I'll be looking for something like this potentially. But I want to see it push up and through and then pull back to hold a higher low. But I want to see it take out some lower highs. When it takes out some lower highs, it means buyers are in control. It's running out of sellers. All right. And then it's about the entry. But rather than buy it within that contraction. So what I mean is if that's your contraction, we get biased up and we go, okay, we're going to buy here. And all it does from here, you get in, you got your stop, you go, great, pops up, you go, look, I'm a legend. But that hasn't broken, and then boom, straight down, stop you out. So nothing's confirmed just yet until it breaks up. It breaks out of that contraction phase. It's either going to consolidate or go higher. Either way, you don't want to be in just yet. You want to watch. All right, I hope that makes sense there, guys. We'll probably finish there. Any questions before I finish up? If there's no questions, I know I just have to wait to stream to catch up. Like I said about next Monday, I will see if I can, but I'll let you know. Just watch out for the alert. So if you got the alerts, normally I send around at 10:30 or thereabouts, 11, to say whether there's going to be a stream that day, generally on the Monday. If you haven't heard anything, more than likely it's not going to be on. But I'll send something out. I'll probably send something out to say no stream today. It's whether I'm having my Christmas drinks or not. But if I don't hear from you, I don't speak to you. Merry Christmas. What is it? Christmas next Wednesday? Am I right? Christmas Wednesday. So I don't speak to you. Have a great Christmas, and I'll send out for the people that are following the alerts through the app, TradeSetup app. Then I'll just send you something about the times we're going to go quiet or we're going to have a bit of a break. Still watching the markets, of course. Watching the markets all the time when they're open. But there won't be that many alerts, so nothing to fear. If we do have positions, we'll still manage those. Potentially, if something looks great, I might send out an alert to buy. I think last year I got caught not in the market, having a bit of a break, and it just took off. So I'll keep an eye on those anyway. But yeah, like I said, have a great time, have a great Christmas, stay safe. If I don't speak to you, if I do, I'll repeat the same next week. All right, guys, enjoy. I'll speak to you again soon. Bye.